Hey, welcome back, options traders. Good morning, everybody. In this video, I wanted to talk a little bit more about this idea of morphing in the right or wrong directions as applied to vertical spreads. And I thought it would be a good topic because we've talked about morphs before, but usually when it comes to vertical spreads, traders get hung up on the credit spread because they like the word credit and they think they're getting paid by the market. Simply not true. Every vertical spread ends up being a debit spread. Well, then that raises a good question. When should we use a debit or when should we use a credit? And there's a lot of different reasons. Two of the main ones have to do with skews, could certainly drive us to a debit or a credit spread. But another one that traders overlook is about the potential morph. And this is where you have to understand this idea of morphing in the right or wrong directions. So what is this all about? Well, let's go find out. As always, before we do, please be sure to click like and subscribe. It is greatly appreciated and helps to promote the channel. Okay, so let's start off with a quick background again, definition of the morph. What a morph is, just think of it as the alteration of a risk graph. We're going to alter it in some way. Now, usually, not always, but it's usually to reduce the risk or to switch directions, let's say from bullish to bearish or bearish to bullish. Could we do it to increase the risk? Absolutely. But most of the time the morphs are done to either reduce risk or to switch directions. Those are really common uses. Now, another little kind of a side note about a morph is that it's usually expected to be in one or two trades. We're not talking about doing a ton of trades because if you included that, well, you could morph a mutual fund into a T-bill given enough trades. Instead, the idea is I've got this vertical spread, and by adding a leg or closing a leg or something, I have completely changed the risk graph, and I've altered some characteristics of it. So that's the basic idea of a morph. All right, so now that you understand that, how do we apply this to vertical spreads? Well, remember, we got to talk about a vertical spread for a quick review. That's where you're going to buy one option, you will sell another option. They have to be the same type, so they're both calls or both puts. Now, this second option that you sell has to have a different strike, but they will have the same expiration. So, for example, let's say that you buy the $100 call and sell the 105 call. Again, let's say for May. They would both have the same expiration, and we would say that you are now long the May 100-105 vertical call spread. This would be a debit spread. All right, so we have to reclassify spreads again. We have debit and credit. So if you have a debit spread, you're going to buy an option. You will sell an option. Again, different strike, same expiration, but you're going to buy the more valuable option. That's what's making it a debit spread. So when it comes to call options, you will be buying the lower strike. So let's say that you buy the $100 call, maybe it's trading for 10 bucks in the market. You would have to pay $10 to buy that call by itself. But then you decide to enter a vertical spread by, let's say, selling the 105 call, which may be trading for 7. So you get this $7 credit, and on a net basis, you have purchased the 100-105 call spread for 3. Now again, the reason that we can look at this and see that it is a long spread or a debit spread is that that's the one that you've purchased. You have purchased the lower strike call. And when it comes to call options, lower strikes kind of have more value. They give you the right to buy the stock at a lower price. And of course, that's why the market has bid its price up to 10 instead of to 7. That's another way we can quickly tell that it must be a bull spread. You are buying the more valuable call. Buying calls by themselves is bullish. And that's really what's driving this strategy. The reason for the sale is to reduce the cost and therefore reduce the maximum loss. So if we looked at this vertical spread here, along the 100-105 call spread, this would be our risk graph. There's our bends that we talk about all the time, 100 and 105. Max loss is 3, and the maximum gain would be 2. So remember, that's found because we have the right to pay 100. We have the obligation to sell at 105, which is 5 bucks. But we paid $3 for that deal, so the largest net that we can put into our pocket is 2. So notice that this bend right here, remember, is our long $100 call. This bend up here is our short 105 call. So what if we wanted to morph this somehow? If I wanted to become, let's say, more bullish. All right, so I'm bullish right now. We can see that. This position makes money if the stock moves in this direction, albeit a limited gain, but it's still bullish. What if something changed in the market? Maybe I break through a resistance point, or some news comes out where I now kind of wish that I didn't limit this upside. Well, I could morph it, and it would be very easy to morph in the bullish direction by simply closing this call. And when I do that, I have now freed up this potential upside. So do you see the difference there? I was bullish with the vertical spread, but I made it more bullish by buying back the short. So if you are morphing a debit call spread, or a put spread for that matter, but when it's a debit spread, always remember that debit spreads morph in the right direction. Now technically they morph in the wrong direction, but it's a little more complicated morph. We're trying to keep these simple. So if it's a debit spread with calls, we were bullish in the vertical spread, we're becoming more bullish. That's what I mean by the right direction. We're bullish before, we're bullish after. So a bull spread morphs to a long call, and again, both of those are bullish. So traders will use debit spreads if concerned about a breakout. They could use put spreads if they're worried about it breaking down. They would buy a put spread, they would close out the short, they're just holding the long put. But the idea is that if you have a debit spread, one of the reasons, not the only reason, but one of the reasons for using a debit spread is it's easier to morph in the right direction. All right, so let's try it with a debit put spread. Let's say that you buy the 105 put and you sell the 100 put. You would be long the 100, 105 put vertical, and it's a debit, and it's bearish. How do we know that it's a debit spread? Well, with puts, higher strike puts are worth more money. So we know that the 105 strike is worth more money because it gives you the right to sell shares at 105. If we had purchased the 100 put, we would only have the right to sell them for 100. So for the puts, the higher strikes are more valuable, and of course they get priced in. So this would be a debit spread, again, because you are purchasing the higher strike put. So if we compare these spreads, in blue is the one that we just saw, the debit spread with the calls, and in red would be our debit spread with the puts. All right, so we are now buying the 105 put and selling the 100 put. That would be a debit spread. But notice if we take the credit side, I'm just going to be the trader on the other side. What's that going to do for my risk graph? It's going to flip it. And that's the credit spread. So I could either buy a call spread and be bullish, or I could sell a put spread. So what happens if I morph this put spread? Well, if we morph a credit spread, again, let's say that we buy the 100 put, we sell the 105 put. We are short the 100, 105 put vertical. It's a credit spread. And now it's going to be bullish. Remember, the person on the opposite side, the person who bought the 105 put and sold the 100, is bearish. So the person on the opposite side of the trade, person who sells the 105 put and buys the 100, must be bullish. So this becomes the risk graph again. Here's our credit of 2, and therefore here's our max loss of 3. Max loss of 3 comes about because we have the obligation to buy shares at 105. That's our short 105 put. We have the right to sell them for 100. Well, if you buy them for 105 and sell them for 100, that's a $5 loss, for which you've been paid $2. That's why your overall net loss is potentially $3. So here's our long 100 put at this strike. Here's our short 105 put up here. So what's the morph? Well, we could simply just buy back this short 105 put. And that's going to look like that. And we are now long a $100 put, which does what? Flips us. We now have unlimited gains to the downside, at least down to a stock price of 0. So what do you want to take from this? Whenever you are morphing a credit put spread, remember that credit spreads morph in the wrong direction. And what I mean by that is it's easier for them to morph in the wrong direction. If you start out as bullish, you can easily flip it to bearish. If you start off as bearish, you can easily flip it to bullish. So if that becomes a concern in your trade that you might be reversing directions, so let's say the stock is maybe bumping up against resistance and you think it might be heading south. Well, in that case, sure, you might start off with a credit bull spread so that you're bullish, but if it turns around, it's easier to morph to the bearish side. All right, so remember that bull spread morphs to a long put. It's going to morph to the wrong direction. You're changing from bullish to bearish. So again, the reason that traders might use credit spreads, one of the reasons, is if they're concerned about a reversal. So I hope that sheds a little bit more light on some of the reasons for considering a debit spread or a credit spread. Again, it's the ease of the morph. Now, we could also look at skews, which is probably an equally important, or if not more important, reason for choosing debit or credit. But the one thing you want to take from this is that the reason for choosing a credit spread is not because you're getting paid, and that it's better to receive a credit instead of a debit. They are all debit spreads once they're executed. You have to dig deeper and find out better reasons for choosing debits or credits, and always remember that one of those reasons is the ease of the morph. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.